SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi Panel Discussion on the recent market turmoil, lessons for market exits of systemically important banks. Before we start, let me thank David Llewellyn for the original idea for this webinar and Stefan Schmitz for the detailed design and the speaker selection. We are also very privileged to have Markus Schwaiger, Director of the OeNB's Department for Financial Stability, to moderate the webinar. Without further ado, let me hand over to Markus.
Thank you, Ernest, and a warm welcome also from my side. Ladies and gentlemen, the recent banking turmoil that we have seen in the US and Switzerland has actually raised a couple of doubts on whether the framework that we have at hand for market exit of large banks, even medium-sized banks, is in all of its details really fit for purpose. In fact, we have seen that for some market players, the combination of very high inflation rates, rising interest rates, and also we have to admit the mismanagement of either interest rate or business model risks have proven too much. And that happened at the wrong time when uninsured deposits actually were standing at record highs after a long period of quantitative easing, and where digital banking combined with the role of social media has made bank runs, so to say, very, very speedy, as some of these market participants have experienced. On the one hand, we of course can say that after all, nothing happened in terms of large implications for financial stability. Market exits were handled well. On the other hand, we also have to admit that these market exits, they happened with public assistance, be it in the form of central bank liquidity guarantees or the extension of deposit insurance beyond what would have, in terms of statutory limits, been foreseen. And in that context, I think it is very timely that both authorities in the US and the European Union have actually tabled proposals on how to develop the current framework further. Now, I dare say that also people either in the Commission or the FDIC were a little bit surprised on the speed at which this issue gained prominence recently, because I think they have been working on this issue for a rather long time and not just for the couple of days or weeks. But it is, I think, a very timely discussion that we are having. So let me be a little bit provocative in the sense that out of the great financial crisis, I think a lot of countries came out of that with a never ever again momentum when it comes to the bailout of large, too big to fail institutions. And yes, I think we have had a lot of change in the system. We have beefed up capital and liquidity requirements. We have improved the resolution frameworks for banks. We've introduced MREL and so on. And yet, whenever even a medium-sized, let alone a large bank is about to fail, we still need or feel the need to discuss the need to intervene in some way or another, which is to say that market exit without some kind of public assistance is still deemed either inadequate or too risky. So in that context, the questions we want to ask today is, what are the lessons learned we can draw from those recent instances of the failure of banks? What are alternatives to resolutions, advantages and disadvantages of these alternatives, and how do macroprudential policy frameworks and macroprudential supervision, how does it interact with the framework for the market exit of banks? I'm very happy to discuss these and potentially a lot more questions, depending on the interest of the audience, with a distinguished panel of speakers. Gilles Edwards is the sector lead of European financial institutions at Standard & Poor's Global Ratings in London. He will kind of set the scene by dwelling on his observations from the recent European and US banking sector volatility. Marie Donnay from the European Commission, where she's head of unit, is, I think, the person to talk to when it comes to the CMDI review, so that piece of legislation that actually intends to improve this whole framework, crisis management and deposit insurance framework in the European Union. And I think she will be happy to share ideas that are contained in this proposal with us. Stefan Schmitz, a colleague of mine who is heading Macroprudential Supervision here at the Austrian Central Bank, will try to give you an overview of how we handle this framework in operational terms here in Austria. Rosa Lastra is the Sir John Lubbock Chair in Banking Law at Queen Mary University in London, and she will draw on her research on a sound crisis management framework. And last but not least, Saule Omarova, who is Director for Law and Regulation of Financial Institutions and Markets at Cornell University, will try, as she indicates, to provide a little bit of out-of-the-box thinking, if I may say so, on alternative solutions to the failure or to dealing with the failure of banks. So without further ado, I would like to hand over to you, Giles, please.
I mean, my takeaway from this slide is, firstly, we're getting a lot of questions from investors around this whole topic. It's a big issue in the market. I mean, our main takeaway really is that in some respects, what happened in March and the reaction of the authorities to these events is largely sort of to be expected, let's say. I mean, firstly, we know financial stability trumps everything, right? It's absolutely paramount, and public authorities, strong institutional frameworks will ensure there's a strong reaction, but also there'll be some pragmatism involved. We know the resolution toolkit and the broad crisis management toolkit is broad. It's a toolkit. It won't be used in the same way every time. Different circumstances require specific use of specific tools or whatever. Liquidity support clearly has been a feature in terms of the response. We see that as sort of normal, just a sign of good institutional frameworks. It shouldn't be, let's say, exceptional or unheard of that liquidity support, whether for individual solvent institutions or the broad banking sector, it should be just a consistent feature. We don't see a sort of march back to bailouts based on what's happened, but clearly that remains a possibility. That with the Credit Suisse example in particular, market solutions, ultimately a market solution was found, and we see it sort of as normal that authorities will try and find a market solution rather than necessarily push through and look for sort of resolution or whatever, or allow a bank to fail. But they aren't always on the table. Clearly deposits are special. They may be alienable in Europe and uninsured deposits, but deposits are not normal liabilities. They are confidence sensitive operating liabilities, and seeing the response and systemic risk override being used is essentially recognizes that. Equally, to our view, nobody is trying to protect senior debt creditors, particularly at holding company level. Resolvability, resolution tools were not used this time, but equally we see them as offering some value as a backstop, even if they're not used. No, but there are key questions that you highlight already around, is bail-in resolution really viable? Is it a credible response, particularly for a very large systemic failing bank? On that theme, if we look at Credit Suisse, what did the Swiss authorities said? Well, they basically saw resolution as unworkable in the circumstances. And if you think about that a bit more deeply, we think, well, hang on. So the Swiss were some of the strongest proponents of getting away from bailout after the financial crisis. They were moved, quite rapidly, relatively, to push through resolvability for their largest institutions. These, particularly UBS, Credit Suisse, started with big TLAC buffers in the first place, and then those have been fully built. It did a lot of work in terms of assessing resolvability, and felt that essentially both of these large groups were ultimately resolvable from a technical perspective. And you know, confidence. There was clearly a confidence issue in the banking sector at the time, but it's not like there were lots of Credit Suisses going around in Europe at the time in terms of potential failures. So, you know, there was clearly a market issue, but it wasn't a broad market panic necessarily. You know, 81 holders getting written down. Clearly, there's some irritation around some of those holders around the fact that some shareholders have retained some value. But clearly, it's a big noise, even though these are clearly highly risky instruments. So, what does where does that all leave us, really? I mean, in terms of policy responses, what we see really is quite limited. UK sort of talking about maybe they'll tweak the deposit guarantee scheme. The FDIC is talking about that also, potentially also introducing a long-term debt requirement for the large regional banks. That was potentially already on the table. CMGI Marie will come on to more. Obviously, that was a work in train already. It's not a response to March. It's a long piece of work. We essentially see that as doubling down on the idea of resolution and bail-in, getting away from bailout. And in terms of sort of supervision, which is maybe not so much the focus today, Fed's talking about changing oversight. Clearly some questions about LCRs and how you model outflows. But really, not huge changes though on crisis management. Now, if we think about where US and EU may be headed in particular, what we sort of see is potentially a sort of moving together in terms of the scope of resolution planning. Large regional banks, not just GSIBs, would be subject to resolution planning, some kind of bail-in or extra loss absorption buffer. Resolution, the use of purchase assumption type deals would be more normal in Europe, and as it is totally normal in the US already by the FDIC, with open bank bail-in reserved still for the biggest names. General deposit preference, well, the US already has that. Introduction of that in the EU would not be totally novel. Australia has it as well. And systemic risk exemption in terms of avoiding losses for depositors exists already. So in some respects there could be more similarity. Equally, there would be differences. The EU, European authorities, clearly have more capacity to do preemptive solvency support if necessary, and the scope of resolution planning will nonetheless continue to go down even further into smaller institutions, not just the top tier and the handful of banks underneath them. If we think finally about what it means from our rating perspective, ultimately we've said since 2015 that we see government support in the US and in Europe as uncertain. We sort of never say never. I mean, we don't say it's impossible, but it's not our base case that bailouts will occur. We rather see the use of the resolution toolkit and also substantial work and resources as offering a backstop, a credible backstop, if large banks fail. Equally, OpCo senior debt, senior preferred debt, can be vulnerable to fault in the resolution scenario, and the CMDI proposal could make that more so. If you prefer depositors and separate the two lines of creditors. There's some more technical aspects in terms of rating implications as well, but it's possible that what we may see in the market essentially is some banks choosing to reduce their senior non-preferred buffers and rather use senior preferred to meet MREL if subordination requirement eases, and that could lead to some rating implications for us. Then finally, we still see the EU as a series of essentially largely national banking systems. Clearly, SSM's made a big difference, but fundamentally, without banking union is not complete, EDIS does not exist, and ultimately our rating approach to European banks remains one of looking at individual banking systems, albeit we don't see huge differences now within the euro area in terms of institutional framework and so on. And I'll leave it there.
Thank you very much, Gilles. I think you illustrated very well that there are reasons to think of the glass is half full, although there is still something missing in terms to make it really full. I may at this point hand over to Marie.
Thank you for having me. And on the CMDI package, which is the Crisis Management Deposit Insurance Reform, which we just adopted in April, 1 month ago, on the 18th of April. You have actually many pieces of legislation. I'll just mention them quickly and give you an idea of what is in the package. And then I'll go a bit more on the substance, and I'll try also to bounce back on some of the things that Giles mentioned. But for those who haven't looked at the package yet, you have 4 legislative pieces: the review of the BRD, it's the BRD 3, a review of the SRMR, it's also the SRMR 3, and a review of the DGSD, it's the second review. Then you have a daisy chain proposal, which is a very technical piece I will not comment on today. Accompanying the package, you have a communication on the main elements of the CMDI, but it also places the CMDI package in a broader debate on banking union completion, which you know in Europe has been indeed in the process of being built since the post-global financial crisis response and basically 2012 and the subsequent years. We also have in the package a review report on the SSM, the single supervisory mechanism, and a big impact assessment, which for those who want to know all the analysis, evidence, and number crunching behind the policy design, together with many contributions also by other EU institutions, will give you plenty of things to chew on. It's pretty thick, so it's I personally recommend the reading, but I realize it may not be so easy to digest. So that's the package, and let me now go to my second slide, and where I'll spend more time and try to explain a bit what we are trying to do and what we are not doing in CMDI, so to pitch a bit the substance of the package. As Giles and Markus mentioned already, this has been in preparation for a long time. We've worked on the package for more than 2 years. And of course, it's not as such a response to the failures we've observed in the US or in Switzerland. We would not have been able to draft all this in 3 weeks after the failures in the US, obviously. And also the issues we had identified in Europe, and let's say the European problems were, in our view, very different to what we observed in the US and in Switzerland. Of course, there will be lessons learned exercise in both countries. We've seen some of it from the US already, and we know that the issues are different. So in general, we view the recent events as a good reminder that we need our crisis management toolbox to be operational and at all times, and that it's really timely now for Europe to improve the framework before more failures would happen. So it was in our view, as I said, also needed within the broader debate on banking union, including the completion with the establishment of EDIS, the common guarantee. And also a very important part of the debate in the banking union completion is, as Giles already hinted to it, further market integration, consolidation, cross-border consolidation. It's also something which would be important to really have a well-integrated and consolidated banking union, but it's not part of the package. And for those who are familiar to the debate, you know that in the Eurogroup debate, we've discussed CMDI, EDIS, cross-border consolidation and the so-called home host debate and regulatory treatment of sovereign exposure. The home host debate and the potential for further cross-border integration and consolidation is something very, very sensitive in the EU. On the next bullet, let me, as I already hinted, say that what is in CMDI is anchored in our findings and learnings of the past years, and how the framework has been applied in the EU or in the banking union so far. In the banking union and in the EU, a lot of attention has been dedicated to one of the tools in the resolution toolbox, the so-called open bank bail-in tool. So a lot of attention so far was dedicated to the planning, the preparation, the resolvability of all banks, but mainly the very big ones, the systemic ones, including for the setting up of MREL. Now, we have observed that actually many of the failures observed in the past were not necessarily the G size, the very big ones, but the segment where we needed to operationalize the toolbox better was that medium, smaller sized banks and then the medium segment where the implementation of resolution proved more difficult. And in those cases, the tools in the resolution toolbox we have in mind are of another nature. It's not the open bank bail-in. It's more what we call the transfer strategy or the bridge operation or the asset sale operation, which are much more comparable to the US purchase and assumption, which is the most common tool used by the FDIC and the one we've observed recently. FDIC does that actually for quite large banks, because SVB, by the European standard, would be considered actually a large bank and would have been in our framework captured and quite operationalized already through an open bank bail-in strategy and an MREL, and would have been already subject to an MREL decision in line with the VRD2. So we are looking at those banks which we think are systemic because they may be too big to be liquidated. Liquidation in Europe is part of the continuum of tools, but what we want to make sure is that resolution can be also implemented for that middle segment where the banks are maybe, as I said, too big to be liquidated, and there would be advantage in having a credible and operational resolution toolbox, including the funding. That's very key. On the next slide, I spent some time on that. The funding of resolution is really important, and a lot of the CMDI is around that. As I mentioned already, we have a continuum of tools in the toolbox. The resolution toolbox in the EU is a part of the toolbox which is harmonized for all member states. Banking union, non-banking union, BRD is part of the toolbox which is harmonized for all. Outside the BRD and the resolution toolbox and strategies, you have other tools which are national options, which are available in some member states, but not in all member states. They are anchored in the DGSD, and that's also one of the reasons why it was important to review BRD, SRMR, and DGSD together, to have a coherence in the framework, to make sure we had a good level playing field and incentive compatibility across the full toolbox and the continuum of tools. Those national options are preventive measures and alternative to payout in insolvency. Okay, so some member states have those, but not all. if you don't do preventive measures, resolution, or alternative to payout in insolvency, you have the pay box function of the DGS, which is a default use, the most known use of the DGS, the default use of the DGS, the famous 100,000 guarantee on covered deposits. It's not necessarily the most cost-efficient use of the DGS, but it's the counterfactual of the pay box. So what we are trying to do now in CMDI, as I already hinted, and also Gilles mentioned that, we confirm the paradigm shift from bailout to bail-in, i.e. we want to protect the taxpayers, we want the industry to be contributing to the failure, preserve financial stability, protect depositors, protect financial, protect taxpayers' money. When I say industry should pay, it means the first line of defense is an internal loss absorption, an MREL requirement, which means something higher than own funds, and in the international sphere, TLAC, but in the EU, in the BRD2, we've actually went beyond the TLAC requirements in scope, quantity, and quality. So MREL requirement remains our first line of defense, but instead, if that's not enough, instead of using taxpayers' money, we want the safety net financed by the industry to be effectively used. These are the resolution funds, the SRF in the banking union, or the DGS, which in both cases are contributed by the entire banking sector. I mentioned already that the DGS has been very difficult to use so far, and that the pay box function is the most common use of the DGS, but it's not the most cost efficient use of the DGS. So the CMDI is actually trying to use the DGS in a more economically efficient manner, so that we can better shield depositors, all depositors, by having a more agile and economically efficient use of the DGS, potentially indeed bridging the access to the resolution fund. That's really the core piece of the reform. I mentioned, but only very quickly en passant, that there are also some changes in the DGSD that will improve the protection of the depositors in terms of definition of eligibility and very practical changes in the scope. For example, we now cover public authorities, hospitals, schools, and so on. But what we don't do is covering all depositors or raising the level of coverage beyond the existing 100,000, or introducing a systemic exemption clause as the FDIC has at its disposal and triggered in the case of Silicon Valley Bank. I'm a bit long, but if you allow me one more minute, I'll go to my last slide for today, because I wanted still to quickly highlight the main elements of the package, which I haven't been able to highlight already on my previous slides. I want to draw everybody's attention also on the fact that in the package, we are also trying to improve early intervention measures, preventive measures, and the timely triggering of failing or likely to fail. Because the best way to have a good resolution, credible, operationalized, and as cheaply as possible is to have an early and timely triggering of resolution, so you avoid further deterioration and the losses to raise to some level, which then make the resolution operation difficult. So part of the package, and in the full coherence of and the logic of having more resolution, is also to have more timely resolution and making sure also there are a clear escalation ladder in the early intervention and in the preventive measures, including working through better coordination between competent authorities, the supervisor, and resolution authorities. So that's really part of the package, maybe less known, less contentious, but very important in our view. I mentioned already broader resolution, including potentially for that middle segment. So we are looking at the public interest assessments, and that's where, as you know, you have that discretionary decision between putting a failing bank in resolution or in liquidation. So that's changing in the framework. I mentioned already the big part, which is the funding equation, and making sure that to make resolution credible, you have the available and proportionate access to funding, relying on internal loss absorption and use of the safety net, in particular use of the DGS. To be able to do that, we are harmonizing the least cost test, which will make sure that the means of the DGS will be used in a cost-efficient manner. If there are questions, happy to come back to that. Very key in the equation. And to change the least cost test, we are linking this to the change in the hierarchy of claims, which Gilles mentioned already. We are removing the super preference of the DGS and creating a single tier preference for all depositors. These are the key elements in the architecture of CMDI. There's more, but I'll stop here in the interest of time. Thank you.
Thank you very much, Marie, for this overview. I think you've done a very good job in reminding us all that whenever you touch one piece of the resolution framework, you basically end up having to touch perhaps even issues that range from deposit insurance, depositor preference, right until the treatment of these aspects in the regulatory field. So I think it is really very well shown by you that you can only discuss these things together and not isolate them one by one. I will hand over now to Stefan Schmitz, who I think is going to give us the perspective that we have on Austria on the resolution frameworks and how they work. Given that we had, fortunately or unfortunately, as however you may look at that, 4 cases where admittedly rather small banks did fail over the last couple of years in Austria, and we had to deal with that. But I think Stefan is best suited to guide you through what we draw and drew from these experiences here in Austria. Please.
Thank you very much. I will focus on 2 lessons from the recent banking turmoil, but before I do so, I should state that the opinion I present here is mine and not necessarily reflects that of the Austrian Central Bank. So the first lesson that's key and that we have lived up for a couple of years now in Austria is that ex-ante crisis prevention and ex-post crisis management must be consistent. So a bank that is systemic in death must also be treated as systemic in life, and that's what has not happened at SVB and has not happened at First Republic Bank. So if a failure of a bank is a risk to the financial system, we must aim at making that bank safer, so reduce the probability of failure of that bank, for example, by higher macroprudential buffers and tighter supervision. And we should reduce the costs of such a failure through higher MREL, for example, or earlier failure likely to fail decisions. At the same time, we need to strengthen the risk absorption capacity for the inevitable repercussions of any deposit insurance case or resolution for the other banks that are remaining in the market. And last but not least, we need an efficient insolvency procedure. So how did we deal with that in Austria? We have an integrated macroprudential strategy in Austria. That means that the identification and calibration of OSI buffers is consistent with our own systemic risk analysis of the deposit insurance system and with our own work on the credibility and feasibility test and the public interest assessment for resolution. By that, we can ensure that the way we look at systemic banks before they fail and the way we treat them afterwards is consistent across time. And secondly, what we do is we activate a systemic risk buffer for banks in the system such that they can absorb the ripple-on effects from any kind of market exit, be that insolvency and DGS or resolution. That led to a quite robust system, as Markus said. We had 4 market exits via the DGS and via DGS payouts during COVID-19, broad crisis, and the Russian war of aggression against Ukraine. And despite the fact that there have been 4 cases at pretty much the same time and broad-based stress across Europe and the system, these cases happened without negative repercussions for financial stability and the real economy. And that shows that the market exit of small and medium-sized banks works well, where super priority leads to fast recovery of DGS payouts. Super priority seniority is a key factor in making that system work, and that's why it is important for me. And the second solution is where authorities adopt sound macroprudential strategies to make the system work. It does work. There might be countries in Europe where that's not the case, but it would be easier for these countries to adopt and improve their systems rather than change the entire system in Europe again. And in that sense, it's quite strange that the Commission has chosen the way of the CMDI framework review to increase the cost of insolvency rather than decrease the cost of resolution. General depositor preference increases the costs for DGS and the banking system and society by reducing the recovery for the DGS from the insolvency estate, because it's now shared broader with other depositors that are uninsured, and that's even worse, by lengthening the recovery process. In Austria, that process took a few months, but in the future will take more than a decade. So effectively, we make the deposit guarantee scheme unusable for market exit directly. And by increasing the cost of the DGS payout, more banks become systemic in death, and hence more banks must be treated as systemic in life. That increases the cost for banks and for supervision. The second lesson I would allude to is that a high share of short-term uninsured deposits is destabilizing, both at the bank level and at the systemic level. And it would be paramount now to take action to decrease these large shares of uninsured deposits, either by shifting these deposits to less runnable liabilities within the banking system, but even better outside the banking system. However, also in that case, the Commission takes a different perspective. The general depositor preference reduces the losses for large uninsured deposits substantially when the bank fails, and that works like a subsidy because there's no adequate socialization of that subsidy, and no additional DGS contributions have to be paid for these kind of deposits. And that subsidy works directly via shifting parts of the recovery from the DGS toward large uninsured deposits, and indirectly via shifting the deposit-laden banks into resolution. And only after resolution, the resolution authority will then decide whether these deposits are bailed in or not. So up to then, we don't even know what the distribution of losses in resolution will be, and we can't even fix MREL properly. So I don't think that's consistent over time. For investors, that makes large uninsured deposits even more attractive relative to financial market products, so that's such as commercial paper. To my sense, that really contradicts the objectives of capital market union. There we want to strengthen financial markets and want to promote market-based financing. And here we promote bank-based investments. And the second point is that for banks, that subsidy makes large uninsured deposits even cheaper. Banks engage in maturity transformation, and that increases the maturity mismatch across the entire system. So the effect is that we increase system-wide liquidity risk rather than address the fact that the share of uninsured large deposits is already too large at the moment. The FDIC, to the contrary, does take the lesson the right perspective, and the additional levy they collect is based predominantly on uninsured deposits, and therefore does socialize that systemic risk exception to some extent. The CMDI framework does not. There are ways to do that, and we could probably discuss these later on. So what does the framework then do with these higher costs? It spreads these increased system-wide liquidity risk across the entire euro area in the hope that these additional costs somewhere disappear in the complex web of alternative DGS payments, government guarantees for DGSs, the hierarchy of funding sources is changed there as well, then access to the SRF, to the Single Resolution Fund, where all banking systems in Europe then contribute to bear the costs, and eventually in the ESM backstop. So at a number of points, there is a distribution of losses towards stronger banking system and the public. To me, it seems that the proposal introduces aid through the back door by shifting these deposit-laden banks into resolution and then into the SRF. To conclude, the general depositor preference first increases the costs of DGS cases and makes more banks systemic in death. I don't think that's a very sound way to address the problems we face with resolution. It would be much better to lower the costs of resolution. Second, it increases system-wide liquidity risk by subsidizing large uninsured short-term deposits, when I think it would be much more stabilizing if we would incentivize these investments to less runnable liabilities, either within the banking sector or even better outside the banking sector. Thank you.
Thank you, Stefan. As we have seen, the CMDI proposal is indeed controversial. So Marie will certainly have an answer to a number of the issues that Stefan has raised. I do want to stress one thing which seems important to me, which is the time consistency of a bank or a market player being systemic ex ante and exposed. I think this is something that is really crucial in terms of getting the incentives right. Let me now turn the microphone, so to say, to Rosa. Welcome again. The floor is yours.
Thank you very much for inviting me to share this important and interesting panel with very distinguished speakers and also my very good friend Saule. In my brief remarks on the recent market turmoil and lessons for the exits of systemically important banks, I would like to emphasize three themes, which in my opinion are relevant following the Silicon Valley Bank collapse and the fallout in the US, and also, of course, in Switzerland with Credit Suisse. And then I will also, in these three themes, put some emphasis on what, in my opinion, is also needed to complete banking union in the euro area. And I don't disagree with the previous three speakers. Rather, I would just perhaps other emphasize a couple of issues which are important in my opinion. The first point is that bank resolution, and in particular the resolution of systemically important banks, must be credible. And this means that the options available to the authorities, national or European, international, we are still at an aspirational level, so let's call it national or European, still, banks are resolved mostly on a national basis, other than the European level, which obviously is a jurisdiction when it comes to the euro area. They need to be credible to the authorities and to the markets, and they must be implemented in practice through ordinary and not extraordinary legislation. If every time that we have a crisis, we have to pass extraordinary legislation or to bypass the ordinary mechanisms or to invoke different exemptions, we are not building credibility. Credibility needs to be built ex ante. And I feel that with the latest market turmoil, we have dented the credibility of what we thought was a good resolution framework. And I second that resolution framework. And I think, that the work of the Financial Stability Board on the key attributes, the hardening of the law by putting it into the BRRD and the Single Resolution Mechanism regulation, was a step in the right direction because it created the incentives to move from bailout to bail-in, not so much as a tool, but rather as a philosophy. It created a feeling or a perception. After all, markets are built on confidence, on trust, this intangible. A perception, the confidence that we have tools to deal with banks, large and small, and that these systemically relevant, systemically important banks, they could be dealt with through the new tools that we have developed and that create an incentive not to use taxpayers' money, not to create incentives for too big to fail institutions, or too important to fail, or too interconnected to fail, or too big to jail bankers, or the two B2B facilities and policies. And I'm concerned, I have to say I'm concerned. I think we need a control, alt, delete, and reset from the perspective of what are credible resolution tools that we can adopt nationally and internationally. I'm not comfortable if after the adoption of these very good laws and rules, we continue to go back to extraordinary legislation and exemptions. That's my first point. Second point is that the and I was just thinking when I was preparing my remarks, I'm talking a lot about credibility, which after all, perhaps as psychologists will be better talking about credibility and trust. But we lawyers and economists, when we deal with crisis frameworks, we're dealing about this intangible all the time, this credibility all the time. And we need to enact legislation and policies that can build on that credibility. So the second point is that deposit insurance must be credible and limited. Governments should not extend a blanket guarantee to uninsured deposits. What's the point then of deposit insurance, of explicit deposit insurance? If everyone thinks, well, it doesn't matter if it's insured or uninsured because the government will step in, not even if I'm too big to fail, if I'm just connected to some sector in the industry that is considered to be important or important enough for the national economy to bail me out. And I am very sympathetic to this saying that one can, in a market economy, which I defend, support, and advocate, it cannot be that we privatize the gains and socialize the losses. It just cannot be. So going back, so how can we kind of again reset? We must remember that supervision and crisis management are part of a seamless process. The recent report that has been released by the Fed on the supervision or the failed supervision, Silicon Valley Bank is a mea culpa of things that were done, could have been done better by the supervisors, including a lot of mismanagement. After all, banks fail usually because there's mismanagement. In this case, something very basic, traditional interest rate risk somehow escape the attention of both the authorities until it didn't escape it, and the market participants until, and this is perhaps where we need, this connects my point that we must remember that supervision and crisis management are part of a seamless process. And we need to revamp supervision and regulation with a mix of the old, and for me, interest rate risk management and control is traditional. I mean, after all, the short-term liabilities of banks deposits, which are matched by longer-term and highly liquid assets, loans, unless they have been securitized, is interest rate risk management. Is nothing really super novel. And if you have a portfolio of bonds and interest rates are moving, it doesn't take really algorithms to figure out that you're going to have a problem. So, but we need to mix the old with the new. I'm very sympathetic and continuously learning from a stress test. I was in a couple of conferences, one at the ECB and one in Madrid, where the sessions on stress tests, I found them very, very fascinating for me because that's an area in which I continuously and constantly find myself learning. I think stress test again needs to be revamped to take account of a number of things, a number of scenarios, that not just the traditional models, to think laterally, but also to think traditionally, not to ignore what has been always at the essence of banking, but also to think laterally. I mean, one of the conferences, obviously, they were talking about climate stress test, which I think is very important. And the seamless process between supervision and crisis management, one of the lessons of the recent market turmoil is that we have a new type of bank run, which is fed by Twitter and social media. I mean, the essence of the bank run is always the same, you know, that I need to go first because, you know, any bank is runnable. All the deposits of the bank, you know, even we have just seen the most creditworthy bank in a crisis is runnable. So we need to know that we are entering a new type of runs. And also, and I know my dear friend Saule has written a wonderful paper on Fed accounts, but one thing we need to also be careful is the digital runs, you know, how will the digital run in a world of digital money and CBDCs operate? And again, we need to learn because, you know, clearly these are the reliance on social media, and here my children are always better than me. I mean, I'm much, you know, I think the younger you are, the more you use social media. So I'm perhaps a bit of a dinosaur in this, that I don't use social media as much to my children, but clearly social media has become a way of communication. So my third point is that reforming the crisis management and deposit insurance framework, and this is where I would agree with my colleagues, is very important to complete the banking union, but also to build credibility in the system. And again, this intangible, this credibility, this trust is very important because financial stability is built on confidence. How do you define financial stability? I'm currently advising the House of Lords in an inquiry which is looking at the operational framework of the Bank of England since it acquired independence in 1998. And there are two parts to it. One is price stability, which has been primary objective of the Bank of England since that legislation in 1998. And the second is financial stability, which in the case of the UK, it sits on par with price stability. So they are both primary objectives. It's not like the ECB, in which financial stability is a contributory task. Elephant in the room. How can it be a contributory task? Because of the treaty. But there you go. In the UK, financial stability and price stability, they sit together as part of the primary box. And but when we try to define price stability, whether we like it or not, has been defined converging around the 2% increase per annum in some form of CPI or RPI index. But when we come to define financial stability, you know, we in this room, we all have a notion of financial stability, but where we really have a minimum common denominator is what instability is. We all identify financial instability when it happens because of contagion, because of the effects on the payment system, because of the runs, because of other things. But to define it in positive terms is quite difficult. And we have built a whole framework around this concept of financial stability, where credibility is so important. But as Silicon Valley Bank showed, credibility is very hard to earn and easy to destroy, can be destroyed overnight. So I have recently co-authored a paper with some of my friends, lawyers and economists, Ri Majadi, Emilio Saucoleas, CPS and others, which was submitted at the request of the European Parliament precisely in this crisis management and deposit insurance framework. And I'm not going to go through the report because it's a relatively long report, but perhaps I can summarize what we say in the report. In the report, we say that it is important, in addition to everything else that CMDI is doing, to harmonize key elements of banking solvency regimes across the EU. Those regimes that deal with the institutions like Silicon Valley Bank that do not fall under the systemically category, under the significant category. And so we have resolution for institutions which are significant, but we have reliance on national banking solvency laws which are not harmonized properly. Still, we have very few elements of harmonization for institutions that are not put into resolution. And we need really to look carefully into this, to have effective tools, to look at deposit guarantee schemes. And if I may quote another piece of work I'm doing at the moment, I'm a member of a group of UniDroit, the Organization for the Unification of Private Law, based in Rome, together with some colleagues from around the world. And we are working on the harmonization of banking solvency regimes around the world, and UNIDROIT will be coming sometime in 2024 with a legislative guide. And of course, there are many people from the EU, but there are also people from other parts of the world, and I think will be an important framework. The other thing that I think is important that we do in our paper for the European Parliament is state again something which I've been an advocate for some years, which is that we need to think about granting the European Central Bank a role in the provision of alia, emergency liquidity assistance, the bilateral lending to illiquid but solvent euro area credit institutions. As we know, because of a restrictive interpretation by the Executive Board of the European Central Bank at the beginning of the life of the ECB, where emergency liquidity assistance remains a national task according to Article 14 of the Statute of the European System of Central Banks, while of course market liquidity assistance, as the ECB has amply demonstrated, is a ECB task, and that is in accordance with Article 18 of the statute. But it's about time with the transfer of supervision and resolution to the European authorities and supervision to the European Central Bank, having deprived the national central banks of the power to issue notes, which is very much related to the provision of emergency liquidity assistance, of the power to conduct monetary policy, and of the power to supervise banks, to have them being in charge of emergency liquidity assistance, notwithstanding the fact of the state aid rules and all the other things, is something that needs to be remedied, in my opinion, relatively soon. That's something which I, again, drawing perhaps on my own opinion, we present a recommendation in the report. And then, and I'm only going to second what has been said in the previous presentation very well by Maria and Giles, that we obviously need to improve the deposit guarantee schemes. If anything, again, Silicon Valley Bank is a warning signal of the importance of credibility in deposit insurance and what happens when you don't have it, when you don't have deposit insurance and when you don't have credibility in your existing arrangements. And the aim to create, of course, EDIs in the future. I'm conscious that I am probably consuming my time. Though I have more remarks, I want always to allow time for dialogue and certainly to listen to my friend Saule. Thank you very much.
Thank you, Rosa, and I couldn't agree more that credibility is something that not only is easily lost, but that you can't buy, you can only earn it. And earning it is a very tedious process sometimes. Let me now turn to Saule and to her thoughts on potential alternative avenues to pursue in tackling the problem of bank failures. Saule, the floor is yours.
Thank you so much. It's a great privilege to join such a great panel of speakers today, sort of representing the US perspective on the latest banking crisis. And I'm particularly happy to follow my good friend Rosa's remarks, because I've been nodding my head vigorously when she was talking about credibility, because this is where I would like to put the stress in my remarks today. So in the United States, as you all know, we already have a really well-developed resolution toolbox in the banking sector. We have the well-established scheme for the resolution of banks, and post-2008 also the orderly liquidation and resolution processes for the banking conglomerates. So in theory, we should not really have any bailouts of any banking institutions in the United States. And yet, just in the last few months, we've seen that theory doesn't hold in practice. So what that shows us is that there are deeper problems in the general paradigm of banking, or perhaps even financial regulation and supervision, that need to be addressed if we are serious about learning the lessons of this consecutive and recurring banking and financial crisis. So just to name a few these sort of deeper problems with the paradigm of our bank regulation. For example, our regulatory framework increasingly is relying on complex technical rules, the quantifiable metrics, this sort of tabulations, categorizations of risks, so we can put certain institutions in certain categories, certain boxes with respect to systemic risk or absence of that risk, so on and so forth. Another problem with our paradigm is that it has a predominantly inward-looking posture. In other words, the focus is typical on individual banking firms or the banking sector as the relevant universe for action, in relevant isolation from the broader financial system frequently, but also, and more importantly, from the real economy, from the broader economy. And finally, there is the tendency, the deeply set tendency to push difficult policy choices down to the supervisory level. And that reflects our general preference for individualized, tailored approach to solving problems, prospectively or retrospectively, versus attacking broader structural issues in the financial system or in the banking system. So in the United States, the regulatory response to the recent events, the Silicon Valley Bank and other bank failures, will likely target specific causes of those specific banks' failures. And these are all, of course, necessary and legitimate measures that will aim at improving bank risk management, particularly maybe interest rate risk management, and dealing with uninsured depositor levels and so on and so forth. And also certain measures are highly likely to come aiming to improve the supervisory process. So all of this is great, and all of this can be pursued within the same regulatory philosophy that I've just sort of generally described. But if we are really serious about preventing another banking crisis and the inevitable government bailouts, perhaps we should expand our thinking beyond that. So let me briefly outline just two examples of what that might entail. So first, I think we need to accept that there is a growing need to revisit the traditional notion of too big to fail in the banking sector and take a more realistic view of resolution planning as a tool to prevent this sort of repetition of this persistent public bailout of various banking firms. I think it's safe to say, and I hope I don't contradict previous speakers on this panel, that the intricate post-2008 resolution procedures, including bail-in requirements and TLAC requirements and so on and so forth, are really not a realistic alternative to public bailouts. When push comes to shove, in practice, what we've seen both in Switzerland and in the United States is that the government actually steps in and forgoes all of those intricate procedures we put in place in theory, and instead goes into the preferred solution, right? The preferred resolution method, which is a bank merger. Find and acquire raw for the failing bank. So that's kind of the market solution to this problem. And the problem with that is twofold. One is that that kind of a resolution has a steep price, right? It increases the level of concentration in the banking sector, makes big banks even bigger. JP Morgan, UBS have become bigger as a result of their recent acquisitions. And the government always takes the loss on the deal because those big banks will never actually agree to the deal unless there is a particular sweetener. So there is a public cost. So in addition to that, these types of resolution, sort of practical resolution methods, show that too big to fail really is not about the size alone. The too big to fail problem is a more pervasive problem with all kinds of private banks or bank-like actors of various sizes, able to control an important economic function to an extent that their failure and resolution, however orderly that resolution may be, is effectively a practical and political impossibility. So this is what the problem really is. So we should really start thinking of too big to fail as a structural problem of balancing the public and private powers and roles and responsibilities in finance. Because ultimately, by outsourcing critical public functions of sovereign money creation and credit allocation to private firms, we effectively both cede control of these processes completely and commit to public support of these firms, these private firms, especially at the brink of their collapse. And as long as we are unable to recognize or admit to these fundamental structural dynamics, we are going to inevitably face the increasing deficit of credibility. This is what Rosa has been talking about, the credibility deficit in the United States when it comes to the use of our wonderful, theoretically well-developed bank resolution toolkit. This is the greatest issue right now that we are facing in our financial sector. So one potential structural solution here, admittedly outside the box, admittedly quite radical by various standards, could be offering a public option for deposits and payments. So offering that public option for deposits and payments would unbundle privately profitable lending from this core public utility function of sovereign money creation. The sheer presence of a fully safe public money option, particularly in digital form, which is currently possible because of the technological advances, would fundamentally alter the structure and the incentives within the financial system so that we will not actually feel potentially such pressure to come in and bail out certain private institutions, be they small or medium-sized or large, that we feel today. But of course, it's a huge structural change. So the second issue here that I would like to highlight is that now, with the lessons of the recent crisis in particular, we may need to explicitly incorporate macroeconomic factors into financial regulation and policy decisions. As we know, the Fed's interest rate policy was a major driver of the SVB and Signature failures. And this interest rate policy was a response to structural imbalances in the real economy, partly caused by the pandemics and supply chain disruptions, but ultimately reflecting long-standing building of these structural imbalances in how the economy operates. So typically, the financial regulation and bank regulation are not really concerned about those types of macroeconomic imbalances. So how do we incorporate those imbalances as a potential risk to bank stability into our resolution planning or supervision, right? So the low-hanging fruit here is perhaps more rigorous dynamic stress testing for banks of various size, not just the big banks, that would incorporate those types of macroeconomic vulnerabilities and risks. But perhaps there is space to broaden the regulatory lens when assessing bank performance. The SVB, the Silicon Valley Bank, for example, was clearly more of a niche venture capital firm than a traditional commercial bank. Silvergate Bank, that was the first bank to effectively fail, that triggered the failure of SVB, was a bank specializing in producing financing for the crypto industry specifically. So the question arises, should bank regulators and supervisors now, in the wake of those failures, start looking at the specific economic sectors and particular economic activities into which individual insured banks are channeling credit? In other words, should bank regulatory policy be linked with credit policy? Should we think of credit allocation as an integral, albeit presently largely neglected, part of financial stability toolkit? So an even bolder and more explicitly macrostructural approach to the problem could be to shift focus directly to the structure of the economy itself. For example, by considering the formation of new institutions, new institutional platforms for channeling public and private financing into the critical segments of the macroeconomy that would make that economy more stable, not simply the banking sector more stable, right? So in the United States, we currently do not have such an institution, which is why I have long advocated the creation of a National Investment Authority, a dedicated federal entity that would act as a large-scale lender, guarantor, market maker, but also an equity investor and an asset manager that would direct public and private capital into critical public infrastructure, stimulate productive economic activity, rebuild supply chains, and so forth. What's important for our purposes is that this type of an investment vehicle could augment the existing menu of safe assets in the financial market and drain the flow of money away from destabilizing financial speculation, including things like crypto. And it would relieve the pressure on central banks' monetary policy, which is currently the only tool for managing economic cycles, and which has such a direct impact on financial markets and bank stability, as we have just learned. We typically do not think of this type of reform as a tool of financial stability, but financial system doesn't exist in a vacuum, as the recent events have demonstrated and reminded us. So perhaps this is the time to start connecting the dots between where the money comes from and where it actually goes. So just to conclude, I realize that these types of outside-the-box structural solutions to financial instability are quite politically contentious and complex, but they are complex precisely because they push us beyond the familiar boundaries and because they reflect the complex reality in which we live. And my sincere hope is that we actually start incorporating these types of discussions into our review of what we need to learn from the recent banking instability.
Thank you very much, Saule, with your indeed out-of-the-box thoughts. I think neither the FDIC report nor the Commission report is something where your thoughts would be 100% contained in. But I think that indeed the question of how to deal with critical functions in the banking system and how to deal with these functions in case of a systemic crisis is something that needs to be addressed in order for the current framework to regain or stay, however you may look at it, credible, to regain credibility. At this point, we have collected a number of questions from the audience. I may go back and start with you, Giles. I have in the chat 2 questions which I tried to paraphrase in the shortest possible way. First question was on the Credit Suisse case, what the implications of a failure rating-wise for the remaining banking system would have been. And the second one on the issue of banks getting ever larger post-2008. I think that is a point that has been touched upon also by some of the speakers, by you, Saule, in your remarks. And how these ever more systematic banks, how this is actually reflected in the rating of these banks from your side. Giles, please.
Great. Yeah, so what would have happened if Credit Suisse had actually been allowed to fail? So liquidation probably is the least likely outcome. Arguably resolution. And what would have happened? You would have had, if the resolution planning had been followed, orderly wind down of the investment bank, and without necessary defaults on any of the activities, and the private Swiss private bank wealth management would have either been found a new home or been worked through. But essentially, those functions were sort of less challenged and probably had some life in them. The immediate market reaction would have been probably fairly tumultuous. I mean, you've seen what happened with the AT1 market. When AT1s, it's normal for AT1s to take a lot of losses when a bank fails, one way or the other. Imagine sort of 50 billion plus of holdco senior debt being bailed in. It's not happened so far, and there has to be a first time, I guess, if resolution is going to be credible, open bank resolution. But there would have been a financial stability. Certainly the debt market, no doubt, would have closed for a period, and for that sort of bank debt, and there would have been some kind of financial stability to manage proactively from authorities to avoid wider concerns, and very, very careful messaging. So it wouldn't have been easy, but arguably would have been manageable. But I guess we'll never find out until the next example comes along. In terms of rating implications, I mean, ultimately, it could have validated our view that resolution is credible for potentially credible for large institutions, albeit never actually tested in terms of open bank bail-in. And it wouldn't necessarily have led us to take negative actions on other banks if financial stability had been contained, which it arguably could have been potentially. On the second question about state support, I think the question is, if we say sort of solvency support from governments is not impossible. It's, you know, never say never that there could be some kind of bailout. I think, you know, ultimately we have, you know, under our methodology we have to choose an either or, which is, you know, either bail in or bail out, but not a bit of both. I think the I mean, ultimately, if authorities do offer some kind of support to a bank in stress, we will recognise that at the time. It's not something that we're going to assume when a bank's in fantastic health, but as default scenarios and stress scenarios become more obvious, and we would recognise, you know, the reaction, you know, commitments of support or whatever it was at the time. Banks getting larger, you know, clearly is a, you know, adds a certain dynamic, and thought, you know, adds plenty for the resolution authorities in particular to think about whether a bank is still resolvable when it becomes larger and larger and larger, given the financial stability angle as well. But that's it's a pretty tricky one.
Thanks a lot. Marie, as could have been foreseen, you have drawn a number of questions on the CMDI review from the audience. Let me try to structure them a little bit. The first one is I think, a very principal one, in the sense that David Llewellyn asks whether we need a new balance between regulation, resolution, and deposit insurance, and we need to rethink this balance. I think that has been an aspect that has been mentioned by a couple of speakers, the fact that those things are very interlinked. I would add the question here that has been posed by Robert Bixel just lately, in the sense of what are early intervention triggers concretely that would actually lead to a bank being subject to early intervention. Then there is the question on cost effectiveness. So I think this links to the least cost test that you have been mentioning, and how to prepare or how to compare the different alternatives, resolution, the role of the deposit insurance in resolution, and so on. And finally, there is a question, I think, which especially for the very large GSIPs is really hard to answer, which is how to solve the problem of liquidity in resolution for these mammoth banks in the concrete CMDI proposal, whether there is anything contained in there. And any other reactions that you may have to other speakers as well, because I think a number of speakers have
Yes.
made reference to the CMDI. Please.
I'll do my best. There's only 10 minutes left, and I'm sure the other speakers would like to come back as well. So I'll try to touch on as many as possible of your question, and also other things that I drafted down. On the interlinkages, yes, I can only confirm. You know, historically in Europe, we haven't done the RDSRMR at the same time as the GSD. It's the first time actually we review them together, and we try to review them in a coherent and consistent manner. So we are really trying to make sure that the policy design and the coherence across those different legal pieces is strengthened. And so there's no need of overall or fully changing from paradigm. And there was, in our perspective in Europe, certainly scope of improving the interconnection and interlinkages between them, because depositor protection, depositor confidence cannot be separated from financial stability, and the credibility of the crisis management frameworks depends on all its elements. I think generally, maybe bouncing a bit on that credibility and trying to also address the question on early intervention. I think obviously crisis management is there, but it's only the third line of defense, if I can say. we have in the world, and in particular in Europe, of course, very important prudential requirements, strong prudential requirement, which we in Europe apply to all banks, and also indeed strong supervisory practices with the SSM, being the single supervisor in the banking union, but also somehow setting a benchmark for the entire banking union, and also somehow creating a good peer benchmark for other supervisors outside the banking union. And they have a strong culture of stress testing, including on the interest rates risk that have been highlighted. So I think that the first line of defense is obviously avoiding the stress and making sure that the banks are sound, which we think they are in the EU so far, and we trust our supervisors are really up to the task and doing their job, and so the crisis management, of course, is behind and is part of the full credibility of the package. And the continuum, and how do you further enhance this? Okay, you have in early intervention tools, indeed, intervention ladders with indeed possibilities for supervisors to come in early when they detect some distress, but you are not yet at the point where you are really breaching your prudential requirements or at fault. So you really have possibility to come in earlier with supervisors, clarification of the powers of supervisor, of resolution authority, trying really to exploit as much as possible that space before you are in a fault situation and failing, likely to fail, where then the crisis management toolbox needs to kick in. The credibility of the crisis management toolbox is also clearly anchored in the preparedness. The resolution planning, which goes through cycle, when the plans are further enhanced, when you look at what is the appropriate resolution strategy, when you, through the years, improve the resolvability, when you build up the MREL and the internal loss absorption, that's all part of, indeed, the build-up of the credibility. And when that's not enough, you need the safety net to be available to be fully used. So I think that what is also very important is to stick to the rules. And I think also the European authorities have been very clear there that it should, should it happen in the EU in terms of the loss allocation, which is the most sensitive part when you have a crisis, when you have a bank failing, the most difficult part, the part which I saw one a colleague in the chat asking on the time consistency, the theory of the rules and then the implementation. I mean, clearly there you need to stick to the rules. And we've had in the EU, the SRB, the EBA, the SSM clearly saying, we will stick to the rule. We have a hierarchy of claim, we will follow it. So that's how you have the predictability of the rules for market players and investors, and so that's how you have credibility in the system. That brings me, if you wish, and I've used 5 minutes already, to the use of the safety net and the cost efficiency. I highlighted the importance of trying to limit the economic disturbance in the real economy and the cost efficiency of our safety net, in particular the DGS. I don't have time to go into the details, but before using a DGS for any other rule, other use outside of the payout function, it is constrained by a least cost test, which is an internationally agreed principle in the key attributes agreed in the FSB, in the ID, in the International Association of Depository Insurance, which is already existing in the DGSD, but was not fully harmonized in the EU. So every member state had a different reading on how to do it. And also sometimes that application of the least cost test was different depending on those other use of the DGS, whether it's preventive or a use of an alternative function in insolvency. There is a need to harmonize the least cost test to make sure that when you use a DGS outside the payout function, we have a level playing field, and it is making sure it will be less costly in terms of the DGS means. There is a very useful paper by ECB, I think some of our ECB colleagues are even online today, where they have looked at the risk of shortfall in the DGS when a pay box function is used. I really encourage everybody to read it. It shows really how how the DGS means can be depleted even for a very small bank. Now, let me add in terms of economic efficiency also, then when you use a DGS in resolution, let me take that example, to facilitate a transfer strategy, you also avoid the very disruptive consequences of a payout. You preserve the client relationship. You make sure that a depositor actually continue to have access to its deposit. It wakes up in the morning after it being transferred and the bank that failed being bought by a buyer, the depositor wakes up the next day having access to its full deposits. You know, the household, the SME, that's really preserving the trust of the depositors, stabilizing the depositors, limiting the risk of runs, because otherwise, if they feel they will lose, including in particular for the part that is uncovered, deposits will run for that part that is uncovered, but also very likely for the part that's covered. So you preserve the value by preserving the client relationship. You preserve the franchise value of the bank that you are trying to have merged or bought by another buyer. That's really the FDIC recipe in the P&A. And that also increases the attractiveness for the buyer, because then it takes over a portfolio which is more stable and sticky. It doesn't run the risk that, you know, part of it will continue to flee, and it has more value in what it acquires. So many reasons why, for, you know, when you have resolution, you have the preparedness, you have more or less absorption capacity. If you manage a transfer strategy for those smaller mid-sized banks, you preserve the economic value, you avoid imposing, you know, losses and disturbing the real economy around, you stabilize your deposit base. There are many economic reasons and economic efficient reasons to do that, as opposed to a payout, which is the most costly and the most disruptive for the economy. Let me also add, the DGS super preference is only doing one thing: preserving the contribution by the industry. When you keep the super preference of the DGS, you protect the industry. You don't protect depositors, you protect the industry. Last point on liquidity and resolution. I've actually finished the 10 minutes, so my apologies to the other speakers. Liquidity and resolution is not in the CMDI package. It's something we've worked a lot on together with our SRB colleagues, our ECB colleagues, and also with the ESM. We haven't found an agreement yet, and I would certainly agree that for, you know, liquidity and resolution to a resolved bank, so we are really talking about the liquidity support to the resolved bank. I'm not talking liquidity sector-wide support, which is more in the monetary toolbox, I would say. There in Europe, we will need to continue working on it. At this point in time, the SRF, the Resolution Fund, can provide liquidity, but of course, it has limits in what it can do and in its firepower. Let me stop here.
Thanks a lot. I think we could discuss a lot of these issues for another hour or two very easily. I would, there is one short question, Rosa, to you, whether or not you agree on the fact that alternatives to the resolution strategy is something that is important to be worked on, given the fact that liquidity, either for the large banks, liquidity and resolution is missing, and for the small banks, you very often go into the insolvency procedure. I would then also give Stefan and Saule the possibility to react very briefly in the interest of time to anything they have heard, and would try to conclude then within the next 5 minutes or so, because I think that's about the time frame that we have envisaged.
Thank you very much. Can you hear me? Yeah. So aware of the limited time that we have, and the question is that, you know, if I agree with other scholars that there should be definitely alternative resolution strategies, the answer is yes. And again, it goes in the same line as credibility. We need to be able to devise ex ante, not ex post, not ad hoc, as many resolution tools and strategies as possible that they are credible. And I mentioned before that there is obviously, we have a bifurcation in the EU between those entities that are subject to resolution, which are very heavily harmonized, and those in which we apply national banking solvency proceedings, in which there is very limited harmonization. And so, yes, there is a lot of work that needs to be done to be able to resolve and to provide a crisis management framework that is credible for all institutions, significant and non-significant. And in a way, we have to develop for the banking solvency proceedings that are subject to national law, a kind of harmonized tools like the ones we have for the resolution of significant credit institutions. So for the benefit of time, and that to allow that my colleagues also have a minute, that will be my answer.
Thank you, Rosa. Saule, Stefan, any reactions you have?
Yes, if I may, I think that in Austria, the haircuts on the sales of the assets of the insolvent banks were lower than in the FDIC cases. So insolvency here is more efficient than in the FDIC cases because we have more time. The FDIC often tries to really sell very quickly, as do resolution authorities as well. In insolvency, we do have a lot of time because we do have the DGS to provide the funding for a couple of months, and haircuts were very low over here. The second point is that on liquidity resolution, I've put the link to the SUERF note 222 in the chat. And on stress tests, that's an important point is to model the interaction between solvency and liquidity. And we have a number of papers out on that, in particular on the back book effect, which actually broke the back of SVB and First Republic Bank. Thank you.
Well, I don't have much to add. I found this conversation extremely enlightening and very important. And my only hope is that as we continue to think about better bank regulation and resolution, we do keep in mind the fact that, you know, the financial system and the banking system do not exist in a vacuum. And it is really important to start broadening our lens and include in the conversation various factors that we are currently habitually excluding from it. Thank you for starting this conversation.
Thanks a lot. And indeed, we just started off a topic. I think it would be fair to say that there is quite some way still to go, but I think we need to go down that route because if we really want to achieve financial stability, I think there is a need to think about a framework for market exits that does work. Otherwise, the concept of financial stability will always be just a fair weather construction. And what we need is a concept that stands the test of stormy waters, so to say. In concluding, I want to thank you for sharing your views, my dear panelists. I want to thank our audience for the interest into the topic. And I hope that we, at some point in time, will be able to continue this important discussions. So thanks a lot for joining. And back to you, Ernest.
This closes today's SUERF-BAFFI Bocconi panel discussion on the recent market turmoil, lessons from market exit of systemically important banks. Let me also, from my side, express a great thank you to Markus, Giles, Marie, Rosa, Saule, and Stefan for your rich contributions, and to all of you for your interest and your questions. Bye-bye and take care.
Bye-bye.
Bye-bye.